Hello, everyone. We're doing our monthly What's Trending in CTA, recapping the month of November. And as always, I'm joined by Charlie McGarra. So let's jump right in. I will share my screen. All right. And we have some exciting enhancements to talk about this month as well. But before we dive into that, just wanted to recap where we stand looking back to the inception of CTA in March of 2022. We now have about 8.5% annualized return, outperforming our official benchmark by a little over 7.5%. So still really strong long-term returns while maintaining that core objective of managed futures or trend following in a broader portfolio, which is to diversify against your traditional assets like stocks and bonds. And so you'll see here since inception, negative zero point 0.2 correlation to the S&P and negative 0.36 correlation to the aggregate bond index. So let's dive right into what I think is very important and really exciting, I think, as we think about the growth and the trajectory of CTA. Research project that started late last year between Simplify and Altus partners to start thinking about the growth of the ETF and how we can maintain not only our levers for diversification, but alpha potential as well. And so this resulted in us adding in the month of November, so this is hot off the press, additional markets across interest rates, energy, and agriculture while maintaining that core objective of being a diversifier to equities within a portfolio. So, high level, when CTA first launched back in 2022, we initially had 15 markets that we were trading in. You'll now see we have over 50 markets that we are able to trade in this strategy on a daily basis. This is not the first time we've expanded the list of markets, though. In July of 2024, so about 18 months ago, we expanded that initial list from 15 to about 34 markets, all in North America, so US and Canadian rates and commodities. And then again, thinking forward with the growth of the fund and how we can ensure that we still have plenty of levers to pull. Again, this research project between Altus and Simplify resulted in us adding additional markets still in developed countries, but expanding beyond North America into Europe and UK. And so you'll see on this list quite a few additional markets in the interest rate sector here on the far left, across the curve in many of those developed countries like Germany, like France, Italy, and UK. And then in energy as well, additional oil and gas markets that we now can allocate to within CTA, and then in ag as well, additional markets in cocoa, sugar, and coffee. And so I think what's really important is prioritizing high liquidity. And so you'll notice we didn't go into emerging markets, we didn't go into niche parts of commodities in Europe. So still all developed, highly liquid markets and contracts. And the last thing I would mention is these are not markets that Altus Partners model has not traded on before. Of course, Altus Partners has a hedge fund and separately managed account business, and they're really trading the full global range of assets beyond even interest rates and commodities, which CTA again is just focused on those two markets. So these are markets that their algorithm and model has been producing signals on for their own products and strategies for quite some time. And so it was really just how can we expand our daily liquid US listed ETF to still prioritize that key objective of diversification and allow us to have, again, plenty of levers as we continue to grow and the success that we've seen in the strategy since inception. Charlie, if there's anything else you'd want to add, feel
I
free.
think that's an excellent summary. We're adding some liquid markets that'll give it a bit more global exposure, add some diversification, and add some capacity.
Perfect.
But the key is liquid and a good size spanning set. And we trade these every day at Altus Partners.
And again, the last thing I would say too is this is a list of markets that we can trade in. We don't necessarily need to trade in all these every day, nor will we. And so if you guys are looking at the holdings, which again are listed on our website on a daily basis, you might not see some of these new markets added yet. Again, it's a toolkit from which we can select.
Expansion of our investable universe, more choices on the menu and more opportunities.
Love that. Your words are much more eloquent than mine this morning, Charlie.
Afternoon here. I'm home. It's a long day already.
It's still early here on the West Coast. So just giving a longer term snapshot, the white line you see here is CTA going back to inception, and the orange line is a US 60/40 portfolio. As I say every month, the importance is not necessarily which one is on top, but more so how they move together. And because of the tailwinds and risk assets and the benefits that's provided in both stocks and bonds to a 60/40 portfolio over the last couple months, you'll see that CTA, the white line, has slightly lagged now versus the 60/40, but still maintaining that core objective of diversification against that unofficial benchmark. Now looking at more of a near-term snapshot of performance, again, the white line is CTA. The orange line on this slide is now our official benchmark, which is the SocGen CTA index. And this is for the quarter to date period. Again, please go back to last month's episode if you're looking for more insights in October, but we do show here the full quarter to date performance, and you'll see that drawdown in the back half of October. We talk about that in the last episode. And really then for the month of November, we slightly outperformed the CTA index, and we'll talk about that on the next slide here. But looking back at the trailing 1 year and 3 year periods, and looking at our Morningstar peer category, which is systematic trend, you'll see that we maintain our top quintile performance rankings versus our peers over a trailing 3 year period. So let's dive in then to some more near-term performance drivers. As I mentioned, quarter to date, we did see that drawdown in the back half of October, excuse me, mainly due to gold and cattle. But let's focus our comments, Charlie, more on the month to date performance, where we did see positive returns. We did outperform the benchmark, and maybe we'll talk about what really drove that performance for the month of November.
It's really, to me, a story about metals and that kind of resurgence of the reflation trade. There's been plenty of uncertainty about the Fed and whether they'll be hawkish or dovish, and how the macro data after the shutdown, as it's released, may impact the market. But what's been really notable in that is that although there were a couple of episodic momentum breakdowns, in particular in crypto with a massive rebound, the read-through to that to precious metals really wasn't that strong on the downstroke, and the upstroke has been still quite, I would say, strong. And what that suggests is that there's a different market structure fueling the deleverage in crypto than there is in metals, i.e., perhaps the metals market has a more diversified ownership base than crypto. So to me, it's all about how are gold and silver kind of back at the highs, while other hard assets that are supposedly geared to a reflation type concept are substantially less exposed, or substantially further off the highs rather. And what that tells me, I think, is that perhaps there's a more diversified and deeper demand for metal than some other assets, and it makes me, at a personal level, reasonably bullish on the outlook for the metal sector in both base and precious. And I think that's the story that you're really seeing in the month to date performance. Yeah. So those long-term trends look like they're still intact, I guess, from a kind of quant perspective.
Yeah, and I might mention on this slide as well, many of the key contributors and detractors that you see here. A lot of this year's story has been more in the commodity space rather than rates. We did speak about some performance headwinds and tailwinds due to short interest rates and more of the July, August updates. So again, those are all available to go back and view and understand what the drivers were at that time period. But I think it's really been a story of commodities this year, which if we think about what's transpired in the tariff tantrum and policy, I don't even know what we want to call them, policy shocks, maybe.
Big reversals. I mean, energy was super wild with the Iran-Israel conflict, and sort of will there be gap moves in crude around that. That it wasn't just Liberation Day in April, but it was everything that happened in sort of June and August and so forth. But it's been a wild ride in commodities, where energy really hasn't done that much, and metals feel like they're finally breaking out. And I think, for me, what I'm really looking at is sort of, as that reflation trade, is it going to continue in metals? It sort of seems like the trend is intact. When does energy turn and keep up. And the market is still reasonably bearish on a forward supply glut concept in oil, but if oil can really start to move, it can say something much more aggressive about the global growth prospects and the importance of how little capex there's been in energy over the last couple of years. So to me, it's all about like when does energy invalidate what's going on in the rest of commodities.
And maybe the last thing I would mention, because in meeting with investors and clients, we often get asked the question of, how to allocate to CTA in the portfolio and how it behaves alongside other trend following strategies. And what you don't see on any of these slides, which is very intentional, is any equity exposure or FX exposure. So as we think about that prioritization of that core objective to diversify against the equity risk or beta in the portfolio, we're not investing in equity or FX futures. And that makes us a very differentiated offering within the broader trend universe. And so I just like to highlight that. And that's why in these monthly updates, we are, focused, of course, just on commodity and interest rates as the key
Probably worth
contributors.
probably worth building on that a little bit more for just one moment too, which is this year it's been a fantastic uptrend in equities after April. And it's also been a pretty bearish trend in the yen in FX world. And that's kind of like the stuff that's really worked in trend world. Uh, our product is really designed to not be as levered to those financial assets. And it's all about rates and equities. So it's just trying, or rates and commodities. It's trying to express those global growth and global liquidity and inflation views more directly at the source as a diversifying return stream. And it's been very diversifying this year. It's been
Yes,
very different
yet
than a lot of
that
other
it
things,
has.
for better or worse.
Yes, for
But
better or
I
for
think
worse. And I do think, I mean, one of the common considerations on allocating to trend following, and we've heard this a lot just with what's transpired this year in the industry in trend following, is how to think about this when you're sourcing, right? Because if you're sourcing this from your equity portfolio, and it's meant to be a ballast or an offset, a diversifier to equity, you're kind of already sacrificing some of that beta. And the goal of trend following, its core objective is not to outperform equities, right? It's to diversify against equities. And so I always think that's helpful to help guide investors in thinking about where best to source this from. And of course, a common theme the last few years has been that bonds have not been that diversifier. And so we typically, again, there's no right or wrong answer, but we typically see many of our investors sourcing from bonds. And then thinking about, again, that core objective, has it diversified against equities? Yes. We still have delivered long-term attractive returns, but episodic returns, I think, kind of come with the territory in regards to trend following. So,
that's the
um,
game. That's the game.
yeah. So those are mainly the comments we have prepared here. Again, this deck is always available if anybody would like to reach out or contact anyone at Simplify. We can share this with you. And I always encourage you guys to go back and listen to prior months if there's certain environments or kind of risk off, risk on type episodes that might have driven performance in CTA. We talk about all those in detail. And then you'll just see here the last 3 months as of month end across commodities on this slide where exposure has kind of drifted. You'll see long soybeans at the end of November, and these are sorted from left to right as of November. Largest notional position on the left, shortest notional position on the right. And then, of course, for interest rates as well. Again, we've started to see some of the neutralization of some of that short rates position, which I think with the potential likely Fed cut in the coming week or so here, some of that short rates could even further neutralize because much of that is just driven by the inversion of the curve. But again, rates have not been much of the focus on performance lately. It's been more of the commodity story. So that's all I have for this month. Anything else, Charlie? No.
High dispersion year in commodity world, and that's basically the story. And we carry on. Pretty
Perfect.
excited.
Okay, great. Well, happy holidays to everyone. Thank you for your support. Thank you for your interest in CTA. We're always here to answer any questions, and if not, we will speak to you guys in the new year.